Good morning to all of you. I have a great pleasure in welcoming you all for our Saturday morning knowledge sharing. And today our topic is our insight into ESOPs. Good morning, Sudhakar. Our topic is actually an insight into ESOPs today. And we have an expert panelist with us today. We have a chartered accountant who's actually, you can put up the next slide, please. We have a panelist, a chartered accountant, who's Mr. Anand Joshi. He's actually a chief financial officer for the last 2 decades in the leadership experience in the life, health, and the general insurance. And he's actually looking after the finance function. He will definitely provide you the insight, the ESOP, your structure, our taxability, where it is perquisite, where is the capital gain, all those insight, how we are going about it. We can have his expert knowledge. And he is actually constantly positioned as the finance strategic growth partner, leading to the various teams strengthening solvency, regulatory compliances. And he is also a disciplined AOP and forecasting framework. I welcome Mr. Anand to our webinar. We hope that we will have your greater experience, especially in relation to the formulations and tax aspect, etc. We have another panelist, Mr. Rohit. He is our own fraternity of Company Secretary, and he is associate membership, and he is having 10 years of the experience in the legal and the secretarial functions. He is now currently serving as a senior manager, legal and secretarial of Eternal Limited, a company which is actually formerly known as the Zomato Limited. And he is playing a very key roles in the SEBI regulations, IPO related compliances, FEMA regulation, etc. All these aspects of it. We'll have the insight of the compliance related matters, procedural and other thing, and all the practical views from him. Then again, we have our own Sudhakar. I don't need to give an introduction about Sudhakar. And our presenter today is actually Namrata. Namrata is actually a fellow member of the ICSI of our own institute, having about nearly a decade of the experience in a practice. And she is also a bachelor degree in commerce. She is really a specialized person in the legal and compliance and secretarial matters, and especially with the startup compliances. So really speaking, she will provide us the presentation, and we have the expert panelists. They will add value. They will actually share their practical experiences. As far the topic is concerned, I don't want to say anything more because I expect the panelists to give the importance and other thing and all. I leave to them. But nevertheless, I would like to only say one thing. The employee stock option is nothing but it is a non-cash equity-based compensation, especially used to reward and retain the talented people, especially when you don't have the cash resources, especially in the startup, when they are achieving to the growth stage. So which will provide in the later years the cash income for them under their benefit. There are a lot of startups who actually designed this sort of the ESOP schemes. But again, as it comes to the tax part of it, it is actually two aspects. One is when the ESOP is actually given, I think our tax expert will advise you. The taxable event occurs at two incidents. So one incident when it is actually allotted to them as a perquisite value calculated, that is the difference between the fair market value and the allotted price. That is what on the time of the exercise. But only thing is at the time of the sale, then the taxability will come. What you call it, capital gain tax, etc. We will get to know. But only thing is, yes, this has got the various advantages. You have a different taxes, and then it has had different deferred timings. And of course, there are a lot of integrity is there in come to the ESOP. There is actually a restricted stock option, stock appreciation option, etc. and other thing and all. I think our presenter will go through it. I request all the participants put their queries and questions on the chat box as usual, and this will be get addressed on the ongoing basis. If there is anything left out at the end, we will address to it. And subject to the time availability, participants can unmute and we can talk and interact with the panelists at the end of the session. Over to our panelists. Mr. Anand, I'll seek your introduction on this topic, please.
Good morning, everyone. Thank you, Bala sir, for the introduction, and thank you, Mehta and Mehta, for inviting me on this forum. It is privileged to be here among fellow professionals, colleagues, and students. And this topic of ESOP has gained more momentum in the recent years in the startup ecosystem. And this is, like earlier used to say that it is HR tool for uh, retaining people, but this is not anymore uh, that that tool. It is more of a value creation, and having senior people their skin in the game, and a lot of regulatory bodies. It is not just limited to businesses using ESOPs as a tool to allow people to create wealth for themselves, rather than the regulators like RBI and the insurance regulator. They have mandated in their regulations for KMPs to have ESOP as a part of the compensation. So this becomes a serious regulatory matter also for all the KMPs. And I want to structure my remarks around why companies grant ESOP, how ESOPs are designed, and the governance and regulatory framework. Obviously, Namrata will take care in her presentation. And the basic reason why we see today these startups, when they are having some key people on their KMP panel, they want to encourage the specific talented people to stay with them, who have got the crux or know-how of their products, their technology. So one very important part is that they want them to stay with them longer, to be part of the value creation journey for the organization. And I believe that is how the designing of these schemes will go, because you know I have, at least in three companies I have worked on these schemes, and these schemes are worked backward as to what kind of value creation the shareholders are looking at. If the company is valued at X and the shareholders are looking for a 3 to 4x valuation, the ESOP schemes are designed from the value multiple the stakeholders are looking at, and then the employees are selected who are given the stock options. And the boards and the remuneration committees take a very, very detailed review of all these instruments. And obviously we will talk about this in detail when we go in the presentation. So this is the overview about the ESOP from my side, and I would invite the other panelists to share their views.
Over to Rohit Kumar, please.
First of all, good morning, everyone, and thank you, Mehta and Mehta, for giving this opportunity. And I would admit that the such kind of knowledge sharing program, it helped me a lot during my traveling journey. I always used to watch the uploaded videos and gain the more perspective of the corporate laws. Now, coming to the topic, the ESOP and insight into the ESOP. And as we all know, how the ESOP is key component of the employee remuneration these days, and during the negotiation hiring process is the key part. Like I would say days are the gone, like when people are discussing the salary and other aspect. But now the ESOP is always a central part to the hiring part, and that's why we usually say this is the wealth creation tool. But profession like us, we focus too much on the legal aspect, and we should focus on the different nuances involved into the ESOP part. And the journey of ESOP is quite long. When we say from the grant to vesting, and then the exercise and the selling part, every bit involves a different regulatory mechanism, from the accounting standards to the corporate laws and specifically the insider trading laws. The key aspect which I handle in Zomato is how you can train the employees, because the ultimate beneficiaries are the employees. And most of the tech organization like the Zomato, most are the techies people. They don't understand the different terminology or the nuances of these laws. So what is grant, what is exercise, and the vesting, how they finally realize those value. To train them during the journey is quite important, and we take care of this bit while working in the Zomato. So I'll take a pause here, and we'll look forward to as the session progress. And as Namrata will discuss how this ESOP structure work, the different approval mechanism, and ultimately the employees get the value. And one last point, I just want to give one disclaimer. Whatever I discuss here, these are my personal views and not to belong to the organization where I work. Thank you. Over to you, sir.
Thank you very much, Rohit. As Rohit puts it, I've been also telling in the past, also in the forum, we are actually discussing per se the law, the interpretation, the procedure, the compliances, sharing the personal experiences. Please avoid putting any personalized sort of questions which is actually particular to your organization. This is not the forum to seek any particular opinion, which I wanted to make it very, very clear on that. It's a disclaimer we wanted to actually put it, because when you refer certain matters without knowing the facts, it will not be possible for us to give a definite answer on this. But while we can give the clarification, we can share our practical experiences, we can share the procedural aspects, etc. That will be actually that I would like to make it here. Over to Sudhakar, please. Sudhakar, you are on mute. Sudhakar, you are on mute, I think.
Yeah, sorry. Good morning, everyone. And considering the time constraint, I will skip my introductory remarks and I will pitch in wherever it is required. Because already that Anand and Rohit have set the tone for the webinar, and I request Namrata to take further.
Thank you. Over to Namrata.
Thank you, everyone. I'll just share my screen. So, is my screen visible?
Yeah, perfect.
Some participant have complained about echoing. So if we are not speaking, it will be better if we mute ourselves. Then that will avoid the.
Is my voice clear? And
Yeah, yes, your voice is clear. Your video is also clear. Your presentation is visible.
and
You can
it's
go ahead.
we are shifting
Yeah.
the slides as well, right? So I'll just jump into the topic very quickly now. The topic for today is ESOP. As Anand sir and Rohit rightly highlighted, this is no more a HR tool, right? With the changing scenarios in the startup industry, this ecosystem, it has now become a strategic decision to hold the right talent in the company, which is probably unable to pay or even to ensure the right anti-dilution in place for whatever reasons, right? So we'll just start quickly by giving a very brief introduction about the topic. So ESOPs are now not just the compensation HR tool as we discussed, it's more like a strategic capital allocation, and also impacts how the company's ownership structure, dilution, investor returns, or long-term planning governs in the company. Now, there are 3 to 4 aspects of it. First, impact on the dilution and the EPS. Second, being shareholding pattern dynamics and dilutions. And third is investor scrutiny in listed entities, and then governance and disclosure sensitivity. This basically, all of this deals with how do the company expands their capital base, how they recalibrate promoter and public shareholding, how ESOP and grant size exercises. I mean, I just saw a couple of questions already in the chat box. So all this come together and become the baseline of ESOP policies and ESOP scheme in any company. Next, we have very strong regulatory architecture in place when it comes to the regulations and laws. So we often say there are 4 layers of legal and regulatory architecture here. One is Layer 1 Companies Act 2013, in which Section 62, which talks about issue of share to employees under ESOP schemes. Rule 12, which talks about the vesting exercises and allotment requirements. So basically, we often check Rule 2 before we plan to close the scheme. So governing and preparing the scheme altogether also comes from this background of Companies Act. Then we have Layer 2, which talks about SEBI SBEB Regulations 2021. I'll come to this later. Then we have Layer 3, SEBI LOTR 2015, which talks about governance and disclosure, Regular 17. Board committees, 19 audit committees, 29 prior intimation, 30 material events, 31 shareholding pattern, and Schedule 5, which talks about the annual report disclosures. Then we have NSE BSE operational framework, in which in principle approval is required prior to allotment. And for that, corporate actions prior, of course, and then post-allotment is also required with the depositories. Trading permission, post-allotment is required. We skipped the second point, which is layer 2 SEBI SBEB regulations 2021. This is specifically is relevant more at this point in time because earlier, before September 2025, there was completely different governance rules. But then September 2025 onwards, there was an amendment in the regulation, and this was primarily because a lot of shift is being seen when we talk about the startup ecosystem often, right? So the amendment was set out in such a way that the framework for issuance of sweat equity and the employee stock options by listed companies were redefined for their employees. And the biggest difference here was that this framework does not permit earlier the framework were not permitting the issuance of employees' stock options to promoters or members of the promoter group. Now, when the company, when they prepare for an IPO or, for any expansions, there was this SEBI ICTR rules and SEBI SBEB rules, regulations that govern the whole process. Now, pursuant to this amendment, SEBI has introduced Regulation 9A to the SEBI SBEB regulation, which permits employees of a company who are identified as promoters or members of the promoter group in the company's draft document to continue to hold options, stock appreciation rights, or any other benefits under any scheme that were granted at least 1 year prior to the filing of the draft offer document. So this amendment is a welcome step, in my opinion, that enables founders to be able to take their public issues without having to let their stock entitlements forgo. So the amendment pays heed to the incentives structure that many companies, particularly new age technology startups, etc., have in place for their founders, with share-based benefits often forming a significant portion of the remuneration that founders receive. So this was basically the major shift or change in the SEBI SBEB regulation that came into picture from September 2025 that has really changed the dynamics. And a lot of founders and the founding team members, promoter groups are now happy because of this anti-dilution sort of scheme that came into the picture. Next, we have applicability of SBEB Regulation 3. It applies to companies whose equity shares are listed on a recognized stock exchange. Instruments which are covered are employee stock option schemes, ESOPs, SARs, stock appreciation rights, restricted shares, restricted stock units, and sweat equity. The government's framework schemes are required to be administered by the Compensation Committee in accordance with the SEBI, SBB, and SE regulation. Now, we do not intend to get into the procedural part of filing of forms and directing, but just covered in one slide for ease of process. Firstly, we have to prepare a scheme of ESOP. And I think by far the complete process, when we see this, is the most important and most relevant step when you talk about ESOP, framing a good scheme. So approval of scheme by the shareholders through a special resolution. Then disclosure in the notice of general meeting, mandatory vesting period, as per law, it's minimum of 1 year. Then we have issuance of offer letter in specific format, which is specified in SH8, maintenance of ESOP register, which is as per this format of SH6, filing of return in past 3, annual disclosure in board reports, and then compliance with the accounting standards. Of course, following this, there comes a lot of taxation impacts that other panelists will throw some lights on, but this is by far the shortest procedural aspect of it. Now here is
coming to the framing of the scheme. Yes. I think that is very important according to me. I would look upon to hear from Rohit, especially when you are framing the scheme. What are the precautions? What are the things do and don'ts? Because the scheme is not very clear, then we'll end up in the problem seriously. Your view, please, Rohit.
Rightly said, it's quite one of the first step and very important one, because if your scheme is talking about the time-based vesting or the performance criteria, that should be very clearly written out, just to avoid any confusion at the future stage. And what would be the role of the compensation committee, or I would say NRC, who actually administered, because there are so many matters which you will not call out in the grant letter, during the different documentation, but how you giving the power and how you're recording the decision of a compensation committee while, I won't say deviation from the policy, but when they have a power and they will decide how, like the I would say the acceleration part. Sometimes we accelerate the ESOP. Suppose the initial vesting is for the 4 years, but you want to accelerate within 2 years or 3 years. There has to be the proper rationale, and this everything should be captured in the ESOP plan, and this plan will go to the shareholder. So they will look for all the details what you put while seeking the shareholder approval. And also one more important point, you have to see the proxy advisor recommendation at this stage as well, because sometimes we will just follow the bare minimum law, and if proxy advisor don't understand the plan, they can vote against, and this could be the biggest blocker and your in your ESOP implementation journey. So I think proxy advisor point and how well delineated your policy talks about. So these are two critical aspects which one should understand while framing the ESOP plan.
I would like to add from the CFO angle, what is I mean, when designing the scheme, one is that what is the strategic intent of creating this ESOP scheme? Whether the objective is retention, wealth creation, or business continuity, depending on the cycle where the organization stands, the scheme intent varies, and then depending on the shareholders intention of the pool size dilution, whether it's a 3 to 5 years dilution, or if it is a more than 5 year dilution. If the company is not listed, obviously, I saw someone put a question that whether a company can do ESOPs before listing. So definitely, most of the companies go for ESOP, and now we have seen a lot of companies, the new age technology company like Zomato itself, the other companies which are being listed, when they start, when their business model is successful, they go for ESOPs for their key talents, and the intention is that in 2 to 3 years these people will take the company to a certain level, and then when they do the IPO, the value unlocking for the employee happens. So at the time of designing the scheme, what is the strategic intent, that is very very important. And I think what Rohit just said, that those are considered in the performance criteria. Yeah, Namrata, please carry on.
Yes, sir. Again, I've jumped to the slide next. Visible, right? Is my slide visible?
Yeah, very much.
Yes, Namrata.
Okay. So here, interestingly, there are a few more, new age concepts, as we call it, which are, changing and bringing new dynamics in the ESOP industry and the equity-linked compensation structures. So these are phantom equity and cash settled stock appreciation rights. I mean, without wasting time, I would actually request Anand sir, because he has a hands-on experience on this, to just take these two topics very quickly and share his opinion.
So this is just a spin-off of ESOP scheme. The only difference is that in ESOP you actually get the shares by paying a certain value, which is it could be the strike price or whatever the price which the scheme has decided. While largely in the cash settled, what happened is that the employee is not paying anything. So these are the convenient schemes designed that where the employee is not investing any money, and they are compensated after the certain period and performance criteria fulfillment. It could be 3 years, 5 years. Employee will be paid out the value creation between the grant price and the future price. The only major difference here is the taxation and the cost to company, because when it is cash settled in ESOP, what we do is we do the Black-Scholes value assessment, which is again a model basis that you account for the compensation cost, which is called ESOP compensation expenses, and that is again done by way of actuarial valuation. While in cash settled appreciation rights, it is the provisioning is done basis the uh, expected difference which will accrue to the employee, and it is as good as a salary bonus compensation. So that is the reason it is in the hands of employee also. It is taxable as per their highest slab. These are the major differences. And one of the reason why companies do it where shareholders don't want to dilute their equity. This is for the, I think this is for the seasoned companies wherein the or like say closely held companies where the shareholders are not willing to dilute their equity. In that case, they will take these instruments instead of ESOP.
Going further, we'll just quickly talk about some touch points where how do we design the ESOP scheme. Not exhaustive for sure, depends on each company, how they want to structure it and strategize it, but a few generalized points. So designing the ESOP scheme, core structural and drafting considerations. ESOP scheme is a strategically structured framework that balances talent incentivization, regulatory compliance, and shareholder value protection. So the first thing is pool size. We often hear the term ESOP pool is created once the scheme is in place, right? So that determines the total equity allocation available under the scheme. How much, how many number of shares you'll allocate to the ESOP scheme. So that's there, balancing retention needs with acceptable shareholder dilution. Second is vesting framework defines the timeline and performance conditions that link reward realization to sustained contribution. So this is about the vesting period, which we discussed is minimum 1 year as per the law. Third is exercise price mechanism, establishes the pricing methodology to ensure fairness, transparency, and regulatory alignment. Fourth is lever provisions, specifies the treatment of options upon cessation of employment to safeguard both company and employee benefits. This was amongst first few questions in the chat box also, we'll discuss after the session. Then corporate action adjustments ensures equitable modifications of options in the event of capital restructuring or corporate actions. Then we have change in control clauses. If given in ESOP schemes, company can actually have the control over how they want to change the employees' rights, how do they want to protect it, and in cases where things go haywire, how do they want to protect their rights, the company's rights, in intention to have it back from the employees as well. So protection of employee rights and clarifies options treatment during mergers, acquisitions, or ownership transitions. Then we have a few compliant issuance checklist and the jargons there that we talk about in the grant and offer documentations. So first is board approval of grant. Whenever you're ready to issue a grant letter and offer documentation, you have to get it approved in the board. So prior approval of board and compensation committee is mandatory. Record grantee name, number of options, vesting period, the schedule, and exercise price. Then we have grant letter. Key terms would be the date of grant, number of options granted, again the schedule of vesting, period and price of the exercise, lever treatment, and scheme references. Offer letter, which talks about the issues issued as per the Companies Act requirements, contains prescribed disclosures and terms of offers. And then we have audit trail maintenance mandatory, which updates the ESOP register, mandatory cap tables, and all the documents related to approvals and acceptances prior, in principle, or post allotments. One thing very basic though to make sure is that any of this documentation should not be in conflict with this scheme which is approved. And in case of conflict, the scheme would actually override all the provisions and that would create a chaos in the company documentation. So that is there. Then we have vesting and exercise. Minimum vesting requirement we talked is 1 year, and then accelerated vesting permitted only in specified events such as death, permanent incapacity, or corporate restructuring. Then exercise and allotment process, remittance of exercise consideration. Eligible employee submits exercise application and remits the exercise price within the stipulated exercise period. Board approval for allotment. Board of directors approve allotment of equity shares pursuant to exercise. Statutory filing, pass 3, filing of return of allotment with the ROC. Credit to demat account, allotted shares to be credited to the employee's demat account in compliance with depository requirements. Listed entities, in that case, additional compliance, which will be intimation to stock exchanges, in principle and listing approvals, post-allotment disclosures, and other obligations under the SEBI regulations.
Somebody has put up a question to Mr. Anand from a CFO angle, from the business angle. What are the parameters you think are important deciding whether you want to settle the ESOPs in cash or shares given or the option policy in policy?
So, like I said earlier, this is purely depending on the shareholders' intent whether they want to dilute their equity. Because by doing ESOPs, there could be some dilution depending on the pool of ESOP created. While in the case of cash settled, it is directly hit to P&L, and it is cash distribution. See, if you know that when you do ESOP grants, the ESOPs are, and there was one more relevant question, so I will answer both. There was one question on the valuation. So at the time of grant, you do a fair valuation by a merchant banker. A merchant banker will do the equity or the company valuation if the company is not listed. Obviously, in case of listed company, it is fairly easy because it is the stock exchange price. For non-listed company, you have to get a fair valuation done by a merchant banker, and basis that the grant price is done. If the stock are issued below the grant price, it becomes perquisite for employees. So generally that is not done, because the value will accrue over the period. It could be 3, 4, 5, 6 years, and no employer wants to create a scheme wherein it will create a cash outflow for employees in form of taxation. So that is the reason the ESOPs are granted at the fair value as on the grant date. And the Black-Scholes option value is the mostly adopted valuation method for assessing the value of that option, because because the point here is, if the value on the grant date is, let's say, 100 rupees, so the only way to assess that is a valuation, option valuation, which is kind of a option premium valuation model, and it gives you an approximate of how much value creation will happen, and the cost to the shareholder is accounted for as a expense, compensation expense in the financial statement.
Somebody has actually referred.
Registered valuers are authorized. Registered valuer are authorized. Yes, it is. I think as per section 247. But in ESOP, for different valuation, for income tax you have to have a merchant banker, and for registered valuers, I believe, wherein the ESOP is it is I think it is the right issue. If it is at the same price, then registered valuer is not required. I think Namrata can clarify that.
And somebody has actually put up the question. Most of the investors actually put up a clause in the shareholders agreement regarding the creation of the ESOP pool. I want to understand what is actually the ESOP pool and how they are actually different from the issuance of the ESOP. And as per the compliance requirements, to the time of the creation, ESOP pool, we need to get the ESOP scheme approved. And also you can in basic layman have to ESOP pool.
Sir, ESOP pool is nothing but the pool approved by the board or the NRC committee. uh, NRC committee at the time of formation of scheme documents the scheme, and they approve the scheme. The scheme says that how many total number of ESOPs will be granted over the period of the scheme. So, for example, at the time of launch of scheme, the board has approved total 5 crore units to be granted over the period. In the first year, the grant could be, let's say, 2 crore shares. So the remaining pool, unutilized pool, is 3 crore share, which can be granted in the next year. Or what happens is, when there is attrition happening, some KMP is leaving and a new person is coming on board. How, like Rohit said earlier, that at the time of employee hiring, it's not just the compensation negotiation; it is also the ESOP. So if a person is coming from a startup and joining a different competition, they will obviously come and he will say that, I had so many stock options in my earlier organization, and how much you are going to give me when I join your company. So that pool is utilized later on to fulfill the new roles which are coming on board, and this pool is generally monitored, and it is monitored at the board level.
Okay, Namrata, go ahead.
Sir, I just
Bala,
want to add.
just
Yes.
1 minute, Bala.
Yeah.
Just you have to add further to that. In fact, this pool of shares is nothing but the amount of the units, what the total it is. And it is not only to be approved by the board, it is to be approved by the shareholders also. At the same point of time, that shareholders are also to approve the period actually. Whenever you are floating a scheme, that scheme, there is a particular period. It may be 6 years or 8 years or whatever it may be, because you are not going to give the grants to all the employees at the same time. That ultimately awarding the grants, it is up to the compensation committee. What the shareholders are primarily approving it is the section 62, whenever you are issuing the further securities without issuing the right shares. If you are, that is a employee stock option is an exempted one. So there the shareholders are approving, to that extent their shareholding is getting diluted. So that is very important. Number two is that during that particular period, what they have approved it, this grants can be awarded. As far as the vesting is concerned and exercising is concerned, again, the time limits and all is to be decided by the compensation committee. Number one. Number two, that in case of normally the listed companies, what they do is that it all depends upon whether the grants, what they are giving is the exercise price is also predetermined. That price they may predetermine equivalent to the market price or slightly lesser than the market price also. And accordingly, the requisite tax is to be also paid. It is not like that companies hesitate to that employees have to pay the tax. It is not like that. That maybe in case of a startup schemes. But as far as the listed and well-settled companies are concerned, say for example, in Reliance, when I was working there, I got stock options. And the stock options was at the point of time when the scheme was approved, it was equivalent to the price of the prevailing in the market. So it was 1200 rupees at that point of time. So they are given at 1200 rupees. And subsequently, when by the time when you are exercising, if the price is going up, the differential, whatever it is there, that is going to be your perquisite value, and the perquisite tax is to be paid accordingly. Go ahead, Namrata.
Yes.
Namrata, just can you go to the previous slide?
Sure. Yeah. This one?
Yeah, just for the clarity for the participant, this allotment process is only applicable when you are going for the direct route. So this ESOP implementation is through two process, which Namrata will tell, but this allotment process like filing PAS-3 and obtaining the approval only applicable for the direct route, not through the trust route.
Trust routes, yes. Okay. Going further, the in principle approval, exchange regulatory compliances, clearance. In principle approval is the stock exchange pre-issuance regulatory clearance for ESOP shares. It confirms that the proposed allotment complies with SEBI and is approved as well. The list also is as per the listing norms and capital structure requirement before shares are admitted to listing. The process, very in short, is that you have to file an application to stock exchange, submit the application to the concerned stock exchange prior to the allotment of ESOP shares, then submission of prescribed documents furnishing the approved scheme, shareholder special resolutions, PCS compliance certificate, and SBEP compliance undertaking. And then exchange scrutiny and regulatory vetting will be conducted, wherein examination of scheme provisions, approvals, dilution impact, and conformity with SEBI, SBEB, and SE regulations and listing norms. And then finally, the grant of in-principle listing approval, issuance of formal approval permitting the company to proceed with allotment and subsequent listing process. Then we have exchange corporate action process, which is post-allotment. First is corporate action with depositories, initiation of corporate action with NSDL or CDSL websites for credit of ESOP allotted shares in demat form. Second, stock exchange intimation, LODR compliance, disclosure of allotment as per Regulation 30 of SEBI, LODR Regulation 15. Listing on trading approval, application to stock exchange for listing of newly allotted shares under SEBI Regulation 21. Submission of required documentations, including corporate action confirmation and revised capital structure. Capital reconciliation, updated paid-up capital and shareholding pattern filed under Regulation 31 of LODR. Trading permission, shares admitted to dealing upon receipt of final listing and trading approval from the exchange. Then we have a few touch points in the timelines when we talk about prior intimation corporate actions or governance reports. So here, the regulations covered are 29, 30, 31, 34 with Schedule 5 and 27. Regulation 29 talks about the prior intimation, at least 2 working days prior intimation, excluding date of intimation and meeting for board meetings involving capital structure decisions, example ESOP allotment, etc. 30 talks about the material disclosure, outcome of board meeting within 30 minutes of conclusion, other material events within 24 hours of occurrence. Regulation 31 is shareholding pattern, revised shareholding pattern to be filed within 21 days from the end of each quarter, reflecting post-allotment changes. Regulation 31, read with Schedule 5, annual report disclosures, annual report including ESOP disclosures and corporate governance report to be submitted to stock exchange not later than the day of dispatch to shareholders and at least 20 days prior to the AGM. Then lastly, Regulation 27, which talks about the quarterly corporate governance report to be filed within 21 days from the end of each quarter, capturing ESOP related capital changes. Then we have corporate actions and ESOP adjustments. Regulation 12, SEBI SBEB Regulation 21. Mandatory adjustment triggered by capital restructuring events and capital raising year structural events. It includes consolidation of share, bonus, or stock split in case of restructuring, and rights issue, new issue basically, or merger acquisition amalgamation in case of capital raising. Here, exchange scrutiny focus areas basically on fairness of adjustment formulas, valuation neutrality, and value protection. Then we have ESOP trust root compliance that we were mentioning, that Rohit was also mentioning in the earlier slide. Here, ESOP trust root compliance framework include Regulation 1627, SEBI SBB, and SE Regulation 21. Secondary acquisition limits, trust acquisitions from secondary market subject to prescribed overall and annual caps. Funding restriction, strict limitations on company funding, loan guarantee to the trust except as permitted under regulation. Enhanced disclosure requirements, periodic disclosure to stock exchange regarding trust transactions and shareholding. Shareholding pattern impact, trust shareholding separately to be reflected under non-promoter, non-public category in shareholding pattern filings, filings. Then continuous exchange monitoring, ongoing scrutiny of trust acquisitions, transfers, and compliance with SEBI and LOTR, SBI, and LOTR provisions. Then we have pre-listing ESOP governance review. Here, firstly, we have to make sure that it's the process.
Namrata,
Yes, sir.
Namrata, 1 minute. Bala, there are a lot of questions out there, before going to that
We
pre-listing
can
and
take
all, why can't the questions be addressed first? Bala, you may consider that.
Okay, we can do that also.
Yeah, please do that.
Let's start from the beginning. In a private limited company, and directors are actually trying to grant the ESOP to the key employees. However, they are actually concerned about what happens if an employee leaves the company after the shares are issued. How can the company ensure the shares are actually taken back or control over the employees exist? What mechanism can be put in place to retain the control on such shares?
Can I add?
Yeah, sure.
So I think first of all we understand the vesting period is 1 year, but post that there should not, but there is no restriction. But you can mention in your policy for the lock-in requirement. Through that, once the employee get the share, still you can retain that person until the lock-in expire, so that you can govern through your policy.
Again, coming back, the
Just 1 minute,
document
Bala.
should be, yeah.
Bala, 1 minute. See, that when the employee resigns, how the shares have to take it back. It is not like that. It never happens like that. You will take the shares back from him and all. It also depends upon the listed company as well as unlisted company. Whatever the way you are going to do that, you have to address that issue very clearly in the scheme itself.
Yeah, that is it.
At the time of resignation of an employee, how it works. At the time of retirement of an employee, how it works. At the time when you are taking any disciplinary action against the employee, how it works. You have to address these issues very clearly in the scheme itself.
Correct.
So
That's what,
normally, yeah,
that is
yeah,
what
go
I
ahead,
said
Bala.
actually in the beginning. Yeah. Yes, go ahead.
So normally what happens is that once the shares got, I mean, when the grants are vested in you, you have the right to exercise that options, whatever were vested in you. And then within how much period you have to exercise that. and at what price. That is also addressed in the scheme itself. So normally when the grants are there, in the initial period, every employee will be intimated that you have been granted so many grants, which will be vested in you over a period of time. It is not like that after 1 year, the entire grants will get vested. It again depends upon the scheme because you have to retain the talent. So normally what companies do is that say 25% or 20% of the grants will be vested in the first year, then second year, third year, fourth year. Again, there also that it is not like that it is your birthright that you will get the grants. It all depends upon I mean, again, you have to devise in the scheme how the grants will be vested in you. That vesting takes place after 1 year, but not the entire thing. It is again that only 4 to 5 times it happens, as I mentioned to you. It depends upon the performance of the company. It depends upon the performance of the department. It also depends upon the performance of the employee. There are several restrictions are there in that. It may so happen if you are not performed well, say for example, a particular the employee rating you have to get it, you haven't got that thing, you may not get that, and that those grants may be even lapsed also. It's not necessarily you have to get that thing. It all depends upon because employee stock options is not without even working also you will get it. It is not so. You have to also perform, then only you will get that. So in case once the shares got allotted to you, they're allotted. You will never take it back. Say, for example, if a person is resigning, whatever the grants which are not vested upon you, they will get lapsed. And similarly, the grants which are already vested, which are yet to be exercised, normally what happens is the company will give you that before you leave the company, you have to exercise that. So it all depends upon the scheme, how you are addressing. That's why drafting the scheme, addressing these issues to ensure your what's called as that propensity of litigations that ought to be curbed. So it should be at the same point, it should be no doubt about it, should be an employee friendly scheme. But at the same point of time, the employees are also are not to take the company for granted or for a ride also.
Thank you, Sudhakar. Absolutely, you touched upon the very right point. Because the scheme has to be perfect in order to avoid any litigation. That is one thing very clearly you said. That is why we need our professional, our company secretary should be actually equipped to do the proper drafting. Although we have a subject drafting, cleaning, etc. and all those things, I still see that we are not up to that. We need to address. That is one thing.
Just let me add one or two things. Let me add one or two things before I forget that. That is the reason actually when you are awarding the grants to the employee, along with the grant letter, you have to also attach the scheme. The employee has to accept that so that tomorrow she should not dispute that. Look, I am not a party to the scheme as such. Number two, that's as I mentioned, the draft scheme is to be approved by the shareholders. Normally, what the shareholders do is by that they authorize the compensation committee or whichever the committee you may call it as. Normally, NRC may act as a compensation committee, and that they authorize the compensation committee to ensure the implementation as per the scheme approved, and also to make minor changes wherever it is required. And if any kind of change which is detrimental to the interest of the employees of the company, again the company has to go back to the shareholders for their approval. If it is not detrimental to the interest of the employees, the board itself or the compensation committee itself, whoever is being authorized by the shareholders, they can address those issues.
One thing, another thing is, as you rightly said, anything can be done before the option is actually exercised. Once it is exercised, allotted, there is no way of actually taking back it. Once it is granted, is actually granted. That is the thing. Till then, yes, control is with you. So once it is done, there is no recovery back or something like that. If a company want to issue the ESOP before going to the IPO, can it do so? I think this has been, we discussed this actually. Somebody put what is SBE scheme. I already answered. People should understand this thing because this is nothing but a share-based employees benefit and the security, which she has been actually addressing is one of the SEBI regulation. Issuance and offer letter in SSB for buyback, in my opinion. Somebody put a remark. Is ESOP entity application for listed shares? ESOP is only applicable for the listed shares. If the ESOP scheme actually mentions exercise price of face value and the grant letter mentions some other price more than the face value, then what would be prevail?
It cannot happen like that, Bala, that whatever the exercise price, it is predetermined and it is in that draft scheme itself, which is approved by the shareholders. So as far as the exercise price is concerned, the compensation committee or the board cannot do change that thing. Except that in case of any corporate actions, what Namta has mentioned, at the time of corporate action, the necessary adjustments have to take place. That also in the draft scheme itself, you have to mention it very clearly, and authorization is to be taken from the shareholder. So nothing is
Great.
to be presumed that this is implied, that is implied, and all. The draft scheme drafting itself is a very carefully to be done before the shareholders approve that.
I think next question is relating to the valuation and the block shoes that I think he has already addressed this while addressing the another question. Most of the investors are up to the SSA regarding the certain ESB. This is the, I think, ESOP pool that also we addressed this question. CFO angle that we addressed actually. What if the board is already been authorized to issue grant letter, etc., during the approval of the scheme, or whether board is recording every time new grant letter is actually.
I don't think so. That is the like Sudhakar ji said that the scheme document and the grant letter both are issued at the same time. I mean, nowadays, since we all follow emails, these are issued on emails, and then the employees are practically what happens. I'm saying that employees are supposed to take a printout, sign, and give it back to the HR as an acknowledgement. That's the legal process of doing it.
How does the dividend bonus actually declared and rights issue by the company to the shareholders impact ESOP scheme and ESOP transactions?
See, a ESOP is a ESOP. See, it's a option. It's employee stock option. So it is stock option till the time the employee does not have the shares in his or her demat account. Once the shares are there in the demat account, then it will be treated like any other share. But till the time it is the option has no dividend, no rights. So to get all these rights, it has to get converted into an actual share in the demat account of the person.
SH8 offer letter is the only the buyback. May I know why we are actually mentioning it in ESOP provision? Namrata, what is this? He is saying SH8 offer letter is only for the buyback. May I know why we are actually mentioning in the ESOP provisions?
I'll just check, sir. Meanwhile, when we take the next lot of question, I'll just check that.
Upon verifying the exercise, can NRC allot the authority given by the board?
So we lost your voice. Can you repeat the question?
Upon vesting and exercise of the option, can NRC allot authority is given by the board?
Yeah, as far as share allotment is concerned, anybody can do that, Bala. That board may allot that thing even to the KMPs also, not necessarily. Normally, when the compensation committee is there, which may be NRC in this case, as far as the allotment is concerned, yes, NRC can do that.
Company received the price of.
In fact, let me just for the benefit of the participants, in case of Reliance Industries, myself
0.13 shares in the.
and myself and my boss, we were the two people who were been authorized to allot the shares. So we used to do that on monthly basis. See, it also depends upon, as far as the allotment is concerned, again, the same thing, it depends upon the company. If the shares is quite volatile, the price is very dynamic in the market, listed companies I'm talking about. So that point of time, the allotment take place on monthly basis, depending upon the number of employees, number of applications which are coming. Some cases they do a quarterly allotment also. So there are no hard and fast rules for this. This is entirely dependent upon the company, how they are drafting the scheme.
And sir, nowadays
Company
what happens is that now there are applications, there are very, very sophisticated applications which allow automated the employee get a alert on email, because in case of listed company, the price fluctuates on a daily basis. So if an employee is supposed to get the allotment on let's say 1st of April, if the price is on 1st of April, it's 1,000 rupees, it can go to 1,100 on the next day. So now there are application which allows employee to act on it through the digital system. I think Rohit may be able to share light on that, because they may be using any such app.
So basically, we keep the window like quarterly. We open the window to exercise, and once we receive the application, we take time just to assess the tax liability and communication to the employee. Sometimes there is a soft financing as well. But yes, we also like fixated the price that at this price you are exercising being done. And I think this is the only price which affect the employee, because you have to pay tax on that.
Right.
Rest Once you get the allotment, it hardly matters. That will be into your demat account. You can sell at your own discretion, whatever with the prevailing market price, subject to the insider trading laws. But yes, we usually open window quarterly, and 2 to 3 days we take from the application to the finalization of the process till the we
This
receive
is
the
what
text.
exactly I have mentioned, that whether it is quarterly or monthly, it depends upon the price. Number one. Number two, it also depends upon the number of employees what the company has. Say, for example, in case of Reliance, we used to have monthly allotments. So we have decided that the date of allotment every month, 22nd of the month, the allotment will take place so that the employees can plan their making the application, submitting the applications along with that check or whatever it is and all. And the predetermined exercise price is concerned, that is always predetermined. As far as your what's called as an okay, that when you are making the application along with that check, depends upon that whatever the exercise price is concerned, you have to mention it. The perquisite value is concerned, that will be advised to accordingly, and you have to deposit that also. Or alternately, the HR will deduct from your salary and deposit the perquisite tax. That depends upon that the date of allotment on that particular day, whatever the prevailing market price is concerned, that vis-a-vis the exercise price, that is your perquisite value.
Company received the price of 0.13 per share in the new valuation report. The previous year saw the price of 0.08. Company is currently going through the round of ESOP allocation in this year and would like to do so in exercise the price at 0.01 per share to make it easy for the employees to exercise the same. Is that possible? Can exercise price be less than the valuation, and how can do the accounting for this?
Sorry, sir, I didn't get the question. Can you?
He says company received the price 0.13 per share for the new valuation report. The previous year, it was actually 0.08. Company is actually going through the round of ESOP allotment in this year and would like to do so in the exercise price at 0.01. That is what he is saying. To
The
make it
exercise
easy for
price
the
is always
employee
to be
to
predetermined. Where is the
exercise.
question of changing
Yes,
the exercise price? Yeah.
sir. At the time of the grant, it is basis the valuation. I mean, be it the
Correct,
registered
correct.
valuation or merchant banker. So whenever the allotment happens.
You are on mute. Anand, you are on mute.
Sorry. So in case of, I mean, in the scheme document, the valuation is mentioned, and the how old the valuation can be at the time of allotment. So it is all basis the valuation. It's not on the discretion that the grant price will be decided.
And also valuation, I think more importantly, important from the how ESOP charges being booked in the financial. The exercise price is altogether different, or when the people are submitting the request, it is nothing to do with what we are recording in the books of account. I think the valuation comes into picture for recording this ESOP charge.
Yeah,
But under the
valuation for record charge and also for the fresh grants out of the pool. Yes, because every year the valuation changes, uh, and the new value has to be taken into account
Yeah.
at the time of.
But under the company law, only registered value are authorized for the valuation. Please clarify. I think when you talk about the valuation, it should be a registered valuer only. Na? It cannot be anybody and everybody. Isn't it, Rohit?
Yes, sir. Like this is the followed mechanism, and you cannot obtain from anyone the market via the prescribed rule, and you have to follow that.
Is it different in the IND-AS and EAS?
No, sir, it is not as per the accounting standard. Actually, the valuation is required in, I mean, in all three laws, in the Companies Act, SEBI, and income tax. So, depending on, so what happens is that some companies, they take both merchant banker valuation and also registered valuer. Both valuation are required. So what I understand, that for companies where the shareholding is see, as per then see, the valuation is also required as per FEMA also. So the companies wherein the uh, preferential allotment is happening and all the shareholders are allotted at the same price, I believe the complication is not there. So there are some complications there in what kind of shareholding and allotment is happening. If you have a foreign shareholder, then it is better to take registered valuer and a merchant banker both. And
Yes,
there also the valuation methodologies are advised, not fixed. If someone has asked question that whether Black Scholes is mandatory, so these are advised that any globally accepted valuation method should be followed.
the ESOP model is used in the unlisted company. Listed company can rely on that market price for fair value.
So for unlisted company, it is DCF, the discounted cash flow method, and also nowadays what happens is that if it is unlisted company, some valuation, like I've seen Big Fours using blend of two three methods. Like what they will do, for example, Zomato is listed, and any company within the same industry, if it is unlisted, they will take some portion of Zomato's value. So that is called a blended method, wherein the listed peer valuation is also given a weightage of, let's say, 25-30%. Some weightage is given to the DCF. Accordingly, the valuation is being derived.
If the shareholders have already given the approval of the scheme, that actually contains the specific clause permitting the grant of the option to an individual employees X company, is it still necessary to obtain the separate shareholders approval at the time of making such grant under the regulation 63D of the SEBI share-based employee benefit society equity regulations? Request to clarify.
Rohit, will you be able to take it?
I have not dealt with such situation.
Yeah, because I have not also dealt with this
Sweat
situation.
equity. We don't. I don't work on that.
Question, Bala, can you please repeat it again?
If the shareholder have already approved a scheme that contains specific clause permitting grant of the stock option to an individual employee exceeding 1% of the issued paid up share capital of the company, is it still necessary to obtain the separate shareholders approval at the time of making the such grant under this scheme?
What they have to do is whenever you are giving more than 1%, that point of time you have to specify the name of the company, its designation clearly in the scheme itself. Okay, that means you are giving for if it is less than 1%, you don't need to give the names of anybody. But if it is more than 1%, you have to specify the name of the company, sorry, name of the person and the designation of the person to whom you are awarding that. That's it. Otherwise, you don't need to go back to the shareholders for that again and again. Only
For
thing,
phantom,
only thing as a matter of caution, and okay, that in case of closely held companies and startup companies, when they are awarding these ESOP schemes and all, the exit route is to be clearly addressed in the scheme itself. Because if it is a listed company, you don't need to worry. Because whatever the shares you are allotted and all, you can take back the shares whenever you are retired or you are resigned from the company. The problem comes only in case of companies which are not listed. What is the exit mechanism for that? Whether the employees who are resigning and going out, whether they have to give back those shares mandatorily to the company means, of course, company cannot buy its shares. But if it is to the promoter, who will buy those shares? At what price they will buy the shares? What is the exit mechanism? That is very, very important to know.
equity and SAR cases, if the share price the time was 100 and after 1 year the price is 80 and so have the right to the purchase the employees for the rupees 20 dilution. Just asking under the
I
for
think
the phantom.
it doesn't
Yeah,
happen like that. Once the letter is granted and whatever the grant price is there, if the share price falls, it won't change the grant price.
can ESOP be issued to
In fact, Bala, let me tell you one more thing. Recently, in
other
fact,
than the employees?
one minute, Bala, recently one case came to us wherein that it is a listed company. Exercise price was predetermined, say for 100 rupees. Now, because of the market condition, the share price has come down to 30 rupees. So now the case is that nobody will pick up at 100 rupees. Can the board reduce that to 30 rupees? The board wants to do that so that the employees will buy the shares and all, so that they will get purpose of the scheme is ultimately achieved. Neither the board nor the NRC can change the exercise price. They have to go back to the shareholders, get their approval, get the rate corrected because of the market conditions or whatever it is. though it is not predetermined, but it is going to be predetermined to the shareholders. Shareholders have approved a predetermined price. How can you change it because of the market conditions?
Right.
So this also one has to remember that in case the price is coming down, if the board wants to be very friendly with the employees, they cannot do on their own. They have to go back to the shareholders. So any kind of changes with the deviation from the scheme, it is to be reapproved by the shareholders.
Can a ESOP be issued to the employees other than the employee, that is consultant? When it says it is an employee stock option mentioned only to the employees, how can the other people come into the picture at all? The scheme itself is
Again, the scheme,
very
no, no,
clearly
1 minute.
saying.
Again, the same thing. Bala, again, the same thing. It is to be addressed in the, see, several companies, superannuated employees are taken as consultants. For all purposes, they are more or less like employees only. They are not external consultants. So in such case, you can give the shares to those ESOPs to those consultants also, but you have to address that issue in the scheme itself, and you have to define what sort of consultants it is. It is not like project consultants or somebody like that. No, it is that consultant you have to define in the scheme. You can give the shares. In fact, let me also say this thing: the company, when it is coming with ESOP scheme, they can extend that to its subsidiary company also, not only to the listed company or which are the parent company. But you have to pass a separate resolution for that. Whatever the resolution you are passing, that is not sufficient. For extending the ESOP scheme to your subsidiary companies, you have to pass a separate resolution and get the shareholders' approval for that. You can extend that to the subsidiary companies also.
Sir, I just want to add one point. With regard to the consultant, there is an informal guidance as well issued by SEBI, and one of the condition is that person or the consultant should work exclusively for the group company. So yes, in this case, this can be done.
Again, coming to Rohit, the drafting of the scheme is very, very important to include all these aspects.
Yes, sir. Yes, sir.
If the
In the
drafting
beginning
of the
itself.
scheme is not important, if it's not mentioning anything like that, then without saying it goes only to the employees. That means you have to define the term employees overall, it includes actually here. As Sudhakar puts it, in many of the organizations, yes, people continue beyond the age of the superannuation, they're as good as employees only. But though they are called as a consultant, it is like that. The scheme has to address, so that should be very clear. Okay.
Yeah.
Can a company have two different type of the scheme for ambit of the employees and the KMPs?
Yes, it is possible depending on the tenure. Companies issue schemes, they can issue a new scheme every 2 years, 3 years. Different schemes will have different grant price and different pools. That is totally possible.
Yeah.
If phantom shares are issued, can I be later diluted after minimum 1 year vesting period?
Again, I mean, going back to the scheme, everything is as per the scheme, be it phantom or ESOP. Whatever is there in the scheme, if the scheme allows after 1 year, 3 years, what is the vesting schedule? In some case, it is called cliff vesting, wherein first 2, 3 years you don't get any vesting. It can be like 0, 10, 20, 70, 0, 0, 0, 100. So depending on the kind of vesting schedule the scheme has given, before that nothing can happen.
If the ESOP was granted in the year 2024, can it be given to the employees who joined the organization in the year 2026?
Yeah, if the
That's fine.
scheme allows new employee to be granted out of the pool, it is possible.
What happened in a listed company if the market price falls after the grant? I think Sudhakar has explained this concept actually.
Yes, we have discussed this.
SEBI has also issued the amendment on the 3rd December, replacing the merchant bankers by the registered valuers in SEBI share price option regulation 24. This is the information somebody is putting. Can you please clarify what is the expansions of SBEB and ESOP regulations? SBEB, we talked about stage-based employees
Yes.
regulation. This, I think, why you are asking this fundamental question, I don't understand. How the valuation of the option and the valuation of the share is different, which is to be used to account for ESOP. How the valuation of option and the valuation of the shares are different, which is to be used.
Valuation of share is the value of the company equity
To
divided by the
in ESOP.
outstanding.
Anand?
Yeah, so the valuation of share is the value of company equity. This is for unlisted company. For listed company, the price is there. For unlisted company, as on the balance sheet date, whatever the company equity value divided by the number of outstanding shares is the per share value, and that is determined to grant the stock options. Once the stock options are granted, now depending on the tenure of the scheme, the volatility in the market, there are various parameters which are used by actuaries to determine the option premium of the granted options. So there various methods are available, and prevailing method is Black-Scholes option value method. So the option value is determined to account the expenses, compensation cost, but the fair value of the company is to grant the ESOPs at a particular price.
The option and the shares are one and the same. Till the time the exercise has not taken place, it is called as options. Options granted, options vested. And once options are exercised and the shares are allotted, that is shares. They're not two separate things, according to me.
Sir, the question was why these two different values, so that I was clarifying
Acha,
that.
okay.
Yeah. For the fair value, it is the company fair
Got
value.
it, got it. Yeah.
Option value is because it depends on the scheme. The more see, the more number of years in the scheme, the lesser will be the option. The volatility and all of that. So there are various parameters. It's a very technical thing, and if one wants to learn, they have to understand the Black-Scholes option valuation method.
Okay, I think Namrata, you start now again, and after that, again, Bala will take up the remaining questions along with others.
So we go here, pre-listing ESOP governance review, which has some very basic points. First,
I think this one question we can answer actually. If the company has actually adopted the trust route and going forward and cumbersome and considering the compliances, can the company scrap the ESOP scheme and change to the direct route with a new scheme? What is the process of the scrapping and dissolve the trust?
I think, sir, there is a switching mechanism given from the direct route to trust, if I'm not wrong, in the regulation. I'm not sure vice versa can be done from the trust
They
to
are
direct.
they are talking about trust to direct. They are talking
Yeah.
about. Yeah.
Whenever you are going to the trust route, you have to clearly specify when you are obtaining the shareholders' approval, which route you are taking it, that is also to be approved by the shareholders. You cannot switch over according to me.
Namrata, you continue, then we'll take these questions later. Yeah.
yes, sir. Here, rationalization of ESOP pool to align with the proposed post-IPO capital structure, including assessment of equity overhang and impact of fully diluted shareholder, and then review of the ESOP grants issued to promoters and promoter group entities, ensuring that the IPO eligibility norms now post the amendment in SBEB regulations are complied with, and minimum public shareholding requirements are also in place. Then comprehensive reconciliation of all outstanding options, granted, vested, exercised, lapsed, cancelled, everything, and regularization of pending allotment, ROC filings, and corporate actions. So this slide is basically the summary of all things that we discussed earlier. Detailed secretarial due diligence of scheme approvals, board and shareholder resolutions, and statutory filings under the Companies Act and SEBI, SBB, and SE regulations with corrective actions for any historical non-compliances that comes out in the DD report. Independent merchant banker diligence to validate ESOP documentation, capital structure accuracy, and ARHP disclosures, and to identify potential regulatory dilution or governance risk. Here, I'll just touch point so that we can discuss it in depth once the panelists share their opinion as well. ESOP taxation and India's accounting treatment. Tax implication as per 1961 Income Tax Act says, Section 17(2), difference between fair market value on exercise date and exercise price taxable as perquisites in the hands of the employee. Section 192, employer obligated to withhold TDS on perquisites value at the time of exercise. Capital gain on sale. Subsequent sale of shares triggers capital gain tax with holding period reckoned from the date of allotment. Fair market value considered for perquisite taxation becomes the cost of acquisition. accounting treatment would be share-based payments, ESOPs measured at fair market value on grant date. Section 192 talks about employer obligated to withhold TDS on perquisite value at the time of exercise and expense recognition, compensation cost amortized over the vesting period based on expected vesting.
I just want to add one point in the previous slide. When it comes to the taxation aspect, I think the one practical challenge comes when there is a huge tax liability on the employee. So sometimes they cannot pay upfront. So in this case, company can facilitate or arrange, bringing some third party like ESOP financer who can, grant a loan to employees and they can pay the tax. But in this case, the company should aware that company should not finance directly because of the Section 67 restriction of buyback of the share. So here the company can arrange the third party for arranging the finance sometimes because of the huge tax liability.
Then scheme approval stage, post-approval execution flow, and integrated compliance oversight. This is again more from a summarized point of view. First, board meeting date, consideration and approval of ESOP scheme by the board, prior intimation as per Regulation 29, at least 2 days before, outcome disclosure within 30 minutes, and shareholder approval as per the regulation, SBB and SE regulation. Post-approval, option grant in statutory vesting, option granted pursuant to the approved scheme, subject to a minimum 1 year vesting as per the Rule 12 of companies rules, share capital and debenture rules. Exercise to marketable shares, employee submits exercise application and remits exercise price, and then board approves allotment within 30 days, and then corporate action, and thus the trading and listing approval obtained. Then integrated compliance. Successful ESOP implementation requires structured coordination across Secretarial Finance, RTA, depositories, and stock exchanges to ensure timely filings, accurate capital updates, and seamless regulatory compliance. Very generic do's and don'ts sort of pointers here, which talks about the potential risk and their potential consequences. Allotment of ESOP shares without in principle listing approval from a stock exchanges. Very important step not to be missed out. Grants exceeding 1% of issued capital without separate shareholder approval by special resolution, big no-no. Missing or improperly drafted corporate action adjustment clauses, Regulation 12 SBAB really impacts in future in a very negative way. Delays in mandatory disclosure and filing under SEBI LODR regulations. We often see now that exchanges are, coming behind the companies with more disclosures, clarifications, and emailers to just dig into the matters. So prior hands-on disclosures are required here. ESOP trust breaching prescribed acquisition of funding limits. We do have case laws as well in the upcoming slides, which talk about some of these pointers. Then potential consequences, monetary penalties and regulatory enforcement actions, adverse observations in compliance reports, qualification remarks, freezing of promoter or key stakeholder shareholding, increased scrutiny and reputational risks. Then just a quick conclusion, in a listed entity, ESOP serve as a critical tool to align employee incentives with shareholder value, but their effectiveness depends on the rigorous compliances. They are statutory, regulatory, and exchange monitored and investor sensitive, requiring careful structuring to ensure controlled dilution, governance transparency, seamless approvals, and long-term capital discipline. Ultimately, the scheme is only complete when trading approval is granted by the stock exchange, ensuring both regulatory compliance and realization of its intended strategic purposes. Shall I just quickly also go through the case laws, couple of them?
Yes.
Okay. Here, 197 Communications Limited, which is basically Paytm, post-IPO ESOP controversy. It was a very renowned case, and we often go back to this case to in the practical aspect also. Here, this was post-IPO financial and governance issues, wherein the ESOPs that were granted by the Paytm through their parent company, which is 197 Communications Limited. Here, following its IPO in November 21, the company's share price witnessed a substantial decline from its issue price, which was 2150 then. The core issue arose when a significant number of employees held ESOPs at exercise prices aligned with the IPO valuation. After the market price fell below the exercise price, options became underwater, rendering them financially unviable to exercise. This resulted in erosion of anticipated employees' gains and dissatisfaction within the organization. Further, compliances triggered taxation provisions were upheld, wherein tax liability was triggered at the time of exercise of ESOPs. Employees who exercised options at a higher valuation faced financial exposure despite the future fall in market price immediately following and leading to liquidity and retention concerns. As a consequence of the declining share value, employee satisfaction, the company undertook corrective measures, including repricing of ESOPs, issuance of fresh grants, and restructuring of compensation mechanism. The incident also attracted broader regulatory and market scrutiny regarding startup valuation and IPO disclosures. So this particular case was totally around the pricing of the ESOP and how the market pricing also impacted the ESOP grants and exercise price. Then I'll first touch the third one, which is Reliance Infrastructure Limited, SEBI ESOS disclosure proceeding 2011. 2011 was the time when ESOP disclosure requirements, exchanges were all trying to be more matured, and there were no very strong disclosure requirements as we have now. So the context is that the SEBI initiated proceedings against Reliance Infrastructure Limited for alleged non-compliance with the SEBI ESOS and ESPS guidelines 1999, which were in governance then. Then SEBI examined whether the company had complied with mandatory disclosure requirements pertaining to this guidelines, which were actually not followed, including disclosures regarding grand details, pricing formulas, how the accounting is being done, how the ESOP cost is impacting the profit, and how they are being treated in the annual reports. Also, the stock exchange intimations were not done properly as per the case. During regulatory scrutiny, deficiencies were observed in the manner and extent of the disclosures made to shareholders and stock exchanges. It was emphasized that listed companies are under a statutory obligation to provide complete and transparent information relating to stock option schemes. As such, schemes directly affect shareholder dilution and investor decision making. SEBI issued observation and compliance direction to adhere to those guidelines in force by then, and that non-compliance with disclosure will attract SEBI Act 1992. Thereby emphasizing that transparency in ESOP administration is an integral part to protect the corporate governance and investor protection. So all these cases which were in the initial stage actually helped even the law to mature, because these were the companies who took the new concepts or riskier processes in the very beginning, and thus the law with time matured and brought in the more disclosures and transparency regulations and other guidelines in place. Then we have Rashmi Saluja versus State of Maharashtra and others. Here, the matter concerned alleged irregularities in the grant and allotment of ESOPs. So we often say whatever documents we prepare, right from the schemes to the vesting to exercise, grant letter, offer documents, everything should be in sync with each other. Anything being unaligned or misinformed do attract different kind of irregularities and then the penalties and other procedural requirements. Here, the other party was involved was IRDAI, which was the Insurance Regulatory and Development Authority of India. Now here, the matter was that the ESOPs at Care Health Insurance Limited, a subsidiary of Religare Enterprises Limited, the allegations primarily involved former executive chairperson in relation to ESOP grants made during her tenure. It was alleged that ESOP allotments were not in strict compliance with Section 62 of Companies Act and the related rule, which mandate shareholder approval by SR and proper disclosures and adherence to the procedures. Concerns were also raised regarding possible breach of fiduciary duties of directors under Section 166. So, non-complying with basic laws of Companies Act, the procedural part were actually raised, and the eyebrows were raised basically around those concepts that the directors were with the intent to breach and provide misinformation or hidden information. Since Care Health Insurance is regulated by the Insurance Regulatory and Development Authority of India, the matter also attracted scrutiny under IRDAI's corporate governance guidelines and fit and proper criteria, their specific criteria known to them, to directors and key managerial personnel of insurance companies. Following further complaints, an FIR was registered alleging misrepresentation and statutory non-compliance in ESOP issuance. The director approached the Supreme Court seeking quashing of the FIR. However, the court declined to interfere at the preliminary stage and allowed the investigation to proceed. The consequence was the continuation of the criminal investigation exposes the concerned individual to potential prosecution under the Companies Act 447 attracted, regulatory actions by IRDAI, and other legal penalties. The case underscores that non-compliance in ESOP administration within regulated financial entities can attract both regulatory and criminal expense. And this lastly is of Satyam Computers Services Limited, which was basically about how the treatment is being done in the books of accounts, considering the valuation that were taken and other things. So the matter was in the company Satyam Computer Services Limited, which came to light in January 9. After the confession of chairman, the company had falsified financial statements for several years, thereby inflating revenues, profits, and cash balances. SEBI initiated proceedings under SEBI Act 92 and other regulation against the company and its managerial persons. Among the issues examined was the grant and exercise of ESOPs based on manipulated financial statement, which ultimately brings down that the company's share price was manipulated and thus the exercise price was also tweaked. Now, SEBI found that the falsification of accounts had a direct impact on the valuation of shares, and thus the ESOPs granted and exercised during those relevant period were also affected. The inflated market price enabled wrongful gains to certain insiders and amounted to fraudulent and unfair trade practices under securities law. By order dated July 14, 2014, SEBI directed disgorgement of unlawful gains with interest from the concerned promoters and officials, restrained them from assessing the securities market, and imposed monetary penalties as well. The order underscored the obligation of listed companies to ensure truthful financial disclosure, ESOP valuation, investor confidence, depend upon transparent reporting, and the case become a landmark precedent in Indian governance, corporate governance, highlighting that misuse of financial statements affecting ESOP valuation constitutes serious regulatory non-compliance and attracts strict enforcement under SEBI regulations. So here we do complete the slides, though I would just highlight one point which panelists can also discuss. It's a bit on the insider trading because we do discuss about the pricing in this particular case, right? So yeah, that's on my part and over to.
Thank you, Namrata. Excellent presentation. You have put everything in the very capsule form and explained it very nicely. Put it very nicely. My great appreciations to you. Not only that, when you come to the regulatory part of it, there are regular scrutinies which are actually being done by ROC because now everything is actually gone on the online. They are actually taking the help of the digitalizations. It is automatically things are actually found out. There have been a lot of cases where ESOP shares approval is given for X number of share, but when the allotment comes, it is in excess of the allotment. That means they allotted the ESOP without having approval. Those sort of the cases also come. There are a lot of compliance and non-regulatory issues also come. So one has to be very, very careful when it comes to the compliance matter. I think Rohit will actually tell us on this on ROCs. Now we'll do one thing. We'll go through the remaining questions and then we'll look at it. I'll go back to the place
So
where
just
I
one
left.
point here before I close. There was this mention of SH8 in slide 5 earlier, which which was raised by a couple of years. That had no relation to the other formats. Grant letters and offer documents exist. SH8 offer or formats are not relevant. They are specific to buyback and other options, not here. Just the clarification.
Can anyone confirm the efficacy of the method of the retaining the employees' talent pool? It is much more lucrative to promote startup than accept any ESOP. Can anyone confirm the efficacy of this method of retaining the employees' talent pool? It's a much more lucrative promote and startups than accept any ESOP.
I think I mean, in India, this started as early as around the Infosys time. Infosys, I believe, the first one to do this. And if this method is still prevailing after 35, 40 years, then I think the efficacy is there.
Yeah, another thing is there, especially when it comes to the startup, in the initial stage, what happens is they don't earn any revenue at all. But at the same time, they wanted the talented people to promote because they wanted to actually achieve the growth. In such a case, this is one of the best option, a non-cash benefit, which is attracting the people, retaining them so that it is going to give a future benefit for them. That is how the startups are mostly basically designing their salary structure, less cash in the beginning and more of the non-cash option, which will give it the long-term benefit so that employees' retirement also takes place and they concentrate the company growth they achieve. There are a lot of success stories are there, including the one which has happened recent past was Nika. So like that, there
Yes.
are a lot of things are there actually. Yeah. Rohit,
And
anything you
also,
want to add?
yeah,
Yeah.
sir, just wanted to add like the efficacy you can also judge considering the current eco startup system where the startup company is incurring so much of losses. Actually, there is no cash left to give to the employees or the senior management. I think at that point of time, ESOP is quite handy. They can, give the value and give a trust that if the company perform well in the future, the value eventually unlock for the employees and the senior people. So I think this is a very good system to remunerate the employees when the company incurring the losses. So it's a very good system, I think, considering the today's ecosystem.
How can I get this in the PDF? You cannot get this in the PDF that we have been actually telling in the past also, because the recorded webinar will be disseminated via YouTube and initially only we are actually put up, which is the YouTube, which is accessible. You can actually access the entire presentation along with the deliberations and the questions, etc., which are there. You can actually view the recorded things that is available. You can go through it. Should the ESOP be allotted only to the employees in the roles of the company, also to this we discussed actually. In fact, Sudhakar answered very well on this. What are the benefits to the trust route over direct route?
Can I add, sir? So
Yeah.
I personally believe, in my opinion, we implemented in our company every scheme through the trust route because of the various benefit. First of all, there is a quite operational convenience while you are granting or allotting the share. So there is no allotment process, as Namrata also told, past three, which applicable in the direct route. But in the trust, there is simple transfer from the trust to the employees, and you don't need to go for the various authority, maybe like the exchanges or the ROC from different forms filing. So I believe trust route is much more easy, but yeah, initially there could be a cost to set up the trust, but going forward it will be helpful for implementing the scheme through the trust.
Can you please explain how the special allotment, such as phantom share and SAR, do not dilute the promoter's shareholding?
This we discussed earlier, but since there is no issue of share, the settlement is in cash or cash equivalents. Thereby there is no dilution.
Can a startup company with both Indian and foreign promoters and directors issue ESOP to such promoters and directors under the exemption available to startup companies?
Yes, I believe they can do, considering the certain aspect of the filing requirement. First of all, if the director are foreigner, and there are certain benefits also in terms of the taxation, if I'm not wrong. Uh, the employee does not need to pay immediately the ESOP perquisite tax. So yes, I think they can do the
Yeah,
allotment.
again, coming back, your scheme should be perfect.
Yeah,
That is
absolutely.
that is
That's
the
a
topmost
fundamental.
point. Yeah.
Yeah.
And the perquisite tax is to be paid or deducted by the employer at the time of exercise. So till the exercise is not happening, there is no taxation.
Yeah.
So
Correct.
the very important event is that when someone will exercise only when they see value. If a share of 10 rupees is valued at 20, 25, 30, then only the employee will exercise. And when the employee exercise, the employee will see value in it, and then he will be ready for a tax withhold, because the employer is required to deduct TDS on that perquisite.
Yeah.
If the valuation done So the board and the shareholders can issue the below the valued price. This I think we discussed elaborately in the beginning only. After granting a scheme, is there any provision to make alteration? If so, how?
That I think with the approval of shareholders, the scheme only with the approval of shareholders, the scheme can be modified by. I mean, if the NRC is authorized.
As
That
ICS,
example, Sudharkar sir has taken that example.
yeah,
That,
correct.
yeah.
Since the shareholder is the ultimate authority, the approval, any approval which is be called for the approval of the shareholder, thing can be made. Sudhakar has explained very well actually. As ICSI issued a framework for the drafting of the ESOP scheme. Drafting of the ESOP scheme, what are the precautions, etc. That, but it will depend upon the company to company, what exactly is the situation, etc. But the thing is, all the aspects of the ESOP scheme should be covered, I think.
There is
There
no
cannot be a
model forms.
there cannot be a standard format or standard template or something like that in these particular cases. Because each company is different, each company situation is different. It will differ from company to company. Accordingly, what they wanted to do, they have to draft it with an expert like a professional company secretaries and legal counsel, etc. That's what I think. Sudhagar?
Yeah, correct. And see, there is no guidance note as such. There may be a publication of ICSI for this. But as such, I don't think any draft ESOP scheme has been given in that. A framework might have been given, but not the scheme as such.
Correct.
And I'm sure that there are several companies where on the website the draft scheme of employees may be there. You can
Yes.
always check for that thing. But one thing, Bala, is that the success of the ESOP scheme depends upon how the scheme is framed. It should be employee friendly. It should be transparent enough. It should be simple to understand. And at the end of the day, it should be attractive enough to the employees also. Otherwise, if you are just for the sake of you are doing it an employee stock option and it is very cumbersome, very complex to understand and all, nobody will be interested in that.
Not only that, as Rohit puts it in his introductory speech, actually, when he was referring, first of all, it should be made to understand the employees because the various concepts like, grant, vesting, exercise, all those things, that should be made very clear. Second thing is when the scheme is actually given, it should be not only just handing over the scheme, it should be actually see that virtually they understand the scheme. I think that awareness is really required to be created at all the levels because we cannot expect each and every level of the employees will automatically understand that awareness has to be brought down. That's what I think so. Yes, Rohit?
Yes, absolutely agree, sir.
From a practical perspective, when ESOPs are actually prospective granted employees prior to an IPO, what would be ideal time for implementing the ESOP scheme by making the grants?
This is very subjective, I believe. I mean, it depends. It depends on the management, shareholders.
Yeah.
Specifically, what is generally considered good time gap between the granting of ESOP and the filing and what is that? Filing and punching the IPO, inspecting and mind regulations, accounting and investor considerations. Specifically, what is generally considered the good time gap between granting the ESOP and funding the IPO, keeping in mind regulatory, accounting, and investor considerations.
IPO and ESOP has nothing to do with each other. They're all separate things. It is okay. So ESOP before an IPO can be given, but you don't need to necessarily link that ESOP with IPO and all that thing. Yeah, unnecessarily this person is missing up the whole thing.
What exactly make the difference between the ESOP and ESPS?
See, ESOP, we have already discussed it. As far as ESPS is concerned, it is employee stock purchase scheme. Whenever an IPO, if a company is coming with an IPO, they may reserve some quota for the employees, which is to be clearly mentioned in the prospectus itself, and that is called as ESPS, employee stock purchase scheme. It is. It is only a reserved and assured allotment. That's it. Otherwise, nothing apart from that.
In case of the specimen ESOP scheme, is it available? Would you be kind enough to share this? This is what we talked about it. There's no guide, what you call standard template or something like that. Okay. When ESOPs are given through secondary route, trust which are actually holding the equity shares, that they are treated at par with other shareholders for corporate action such as bonus right, etc.
Yeah, there should be a necessary corporate adjustment needs to be done. when it comes to the trust route, but they are not completely equivalent to the other shareholder in terms of the rights, because the trust does not have any right to vote and other right, like even their disclosure in the shareholding pattern is different. So yeah, but corporate adjustment can be made.
And that is again mentioned in the scheme document itself, that at the time of exercise, the grant price can be adjusted to the tune of the corporate actions.
Yeah.
Do we find the resolution signed by KMP NRC in past 3 for allotment of the shares? What is this particular question is there? I don't know. Do we file resolution signed by KMP NRC
He's
in
asking is
past?
whenever you are allotting the shares on monthly
Yeah.
basis or quarterly basis, whenever the employees are exercising their options,
Mm.
that time when you are allotting the shares and filing the past 3, whether the resolution is to be attached along with that or not.
Okay.
Okay, so whenever I'm not, as far as form filing is concerned, I'm not very confident about it because I don't file the forms. But if along with the past 3, if you have to attach a resolution, here also you have to do that.
ESOP is an independent activity itself. Share can be actually issued under the ESOP by the company for the eligible employees. It is not necessarily that it may part of form of the public. Yeah, it is the answer you have given. I think so. Please clarify. Yeah, you
Another,
said
stop
that.
sharing the screen, please. Yes, Bala, go ahead.
Yeah. In unlisted company, how can we benefit the employees ESOP scheme, and what is the process of the allotment of the share after issuing the grant of the option letter? In unlisted company, how to be benefit the
Bala, this
employees
is what I
by?
have mentioned in case of unlisted company. Because the shares cannot be sold in the market, you have to devise the exit scheme in the scheme itself. Whenever an employee is leaving the company, resigning, retiring, whatever it is happening, so how the exit will be there, how the exit is determined, okay, and at what value, and what is the value determination. These are the issues to be addressed in the scheme itself.
Share issued under the ESOP scheme can be sold by any person at the time of the individual employees in the market for employees bound after the number of the shares of the listed choices of a company itself, or to any other employee or potential employee. Please clarify. No, it can be sold in the market. There's no
Yes.
problem.
Yes.
Yeah.
Subject to insider trading regulations, he can do
Yes.
that.
In case of the private company, when ESOP is vested to the employees, I don't see there is any difference between the private company and the public company. It is everything as per the scheme, whatever the period you are mentioning. That is it. There is no question of separate scheme for the separate type of companies. In a private limited company, there are about 2 directors and 2 shareholders of the company. His IT startup company intends to issue 45% of the ESOP to newly appointed director and whose 63 years old vesting period. However, initially the company intend to transfer the 0.5% share, and then over the period of 3 years, intend to give the 15% of the share to the person. So is the company is bound. Can ESOP be issued?
I think there is a cap of 10%. If the director holding the 10% of the share, that the ESOP cannot be granted.
Does the regulatory compliances process for the Indian company differ in any way where the ESOP is given to those of the foreign parent company?
The question is not clear here.
No,
If any expat employees are there, and you can also extend that ESOP scheme to the expat employees also, subject to FEMA regulations. So that is the only thing what I can say.
if cap limit of ESOP is mentioned in the policy and passed a special resolution, for example, say 20,000 options, but the company has given the option to the employees only 7,000 out of 20,000. Is it mandatory to give the option for the remaining option in the upcoming years? In case where the offered prices under the ESOP is not received from the employees to the extent expected by the company, is the time issue. Those balance shares is to be offered to the consultant or any other person who is actually interested in the offers of the company. Please clarify.
It is, first of all, not an offer like the general offer to the public. It is very specific to the particular employee. And you have to keep in mind, you also need to have the face value concept. So if you don't receive that face value price, you cannot allot the share to the employee, and it's not an offer to the other employee and the public at large.
Yeah, the question is here very clear. Either take it or leave it.
Yes, yes, it's a
If you
right.
take it, if you take it, pay for it.
Yeah,
That's it. There's nothing more than that transfer and other thing and all
yeah,
alert, anybody else, those questions does not come at all actually.
yeah.
Okay. Registered value as per SEBI rules, okay. Can we take a letter from the employees to deduct a part of their salary in consideration for the exercise for the ESOPs in certain periods so that outright payment or the ESOP, which is actually given to the burden to the employees to pay the huge amount at the time of the exercise of the ESOPs?
I think that happens. That is all by design in the scheme. If that is, if at the time of grant, companies what they do is that reduce the number of shares to the tune of the accumulation of value. So, for example, if a 100 rupee share has become 500, so only the appreciation of 400 is converted into number of shares, and the the allotted options are less than the granted option. I think uh, that is the answer to this question.
Well, valuation required to the ESOP grant date or exercise date or an allotment date.
Valuation is on the valuation is required on each of the dates depending on what the event is happening. If it is grant, then the valuation has to happen on the grant date. Value also required at the time of exercise because of the taxation reason. So valuation will be required on each of these events.
11U rules for unlisted company share. What is the 11U rules?
11U rule is the income tax rule under section 57 2A2. So
Income
that,
tax rule is applicable to everybody.
yeah, that rule is prescribed for whether the valuation will be. See, in the income tax also there are two different methods of valuation are defined. One is the DCF and one is the NAV. And depending on what valuation method is being used, if it is DCF, the DCF is done by merchant bankers, and the NAV value is allowed to be done by a chartered accountant. So
What
that
is
is
the
all depending on the situation.
what is the period considered in DCF?
DCF, I mean, the income tax law does not define what is the period is to be considered in DCF, but DCF is a globally accepted valuation methodology, and generally it is the net asset value as on the date of valuation plus the future cash flows of at least 5 years are taken into account. If you are
Somebody
doing
actually, yeah, yeah.
discounted cash flows, so discounted cash flow to be discounted at least for next 5 years of projections, and this is all again subject to scrutiny. The tax authorities, in case of the employee taxation, the tax authority, if there is a scrutiny case for employee, the tax authorities may call for the valuation report being used at various dates.
Anyway, somebody put up a question, information after the grant, Suslan company share price actually fell. Okay. Can the employee be asked to write the board to transferring their ESOP shares before exit? And should they find transferring? This is what we said actually, because once the things are granted, you cannot take it back here. But only
So
thing is, in case of the unlisted private company, Sudhakar puts it very clearly, there should be a exit route. That should be actually mentioned there. That's what he actually said here. So it seems to be it applies more of the unlisted companies where it is there is no question of transferring or something. It should be exit route should be very clearly mentioned here.
I think one thing is very clear, that option ESOP is a option till the time it is not credited as a share in the person's demat account. Once it is share, it is treated differently.
Since Section 67 deals with the company buying its own share is not applicable to the private companies due to the notification of June 16, can we say that the private company can buy its own share of own shares?
See, buyback, I think buyback again will go through the company law rules of, the buyback will have certain 3 4 condition. It has to come out of reserve and surplus, share premium. Buyback cannot happen from the earlier share. So whether it is a private or public, the buyback has to be as per the company's law.
Shareholders, while giving the approval, can they provide for the reduction in the price?
I think we already addressed this question, right?
Yeah. I think the grant price is not generally approved by the shareholders, so no need to go to the shareholders. If the price of the share falls, grant can be cancelled based on the request of the grantee, and then a fresh fresh grant can be made to the employees.
I can only say that read the rules properly. That's it.
While
Okay.
calculating the 1% of the issued capital, excluding the outstanding warrants and conversion, the company at the time of the grant option entire grant to all the employees to be considered, or it is restricted to one employee only. I think he's talking about allotment in excess of 1% of the shares. I think so. That is what it
What is
appears
this
to be.
warrants and all here, excluding outstanding warrants and conversions? See, this 1% talks about employee stock options, not other things. Okay. So you don't need to suppose if that person is having some kind of outstanding warrants and all those things, that is nothing to do with employee stock options.
Is temporary employee, contractual employee, consultant can be issued ESOP in what is that?
In an
Unlisted
unlisted
company.
company. So
I
if
don't
I am not
know.
wrong, employee definition is there in the rules. Okay. So he has to be qualified to be an employee, then only stock options can be given to him.
Right.
If the authorization of the reduction in the excess of the price is given the ESOP scheme itself, then does the board drive the power of the amount to the ESOP scheme already approved by the shareholders? If the authorization for reduction of the exercise price is given to the ESOP
See
scheme
that
itself,
shareholders should never give and they never give a blank approval to the board to reduce the price or increase the price, because otherwise it lost the sanctity of the scheme as such. If at all the shareholders are authorizing the board to adjust the price depending upon the volatility of the market, but that is going to create a rift among the employees for whom we have already given the shares and who are about to give the shares and all. It is ultimately it will be a mess completely. So the scheme should be as watertight as possible. This kind of losers should not be there.
any phantom share governed under the any law in India?
I think at least they are not governed by this ESOP regulations, phantom stocks. And I'm not sure.
Sudhakar was mentioning allotment about the more than 1% equity share. Please clarify its required against specifically resolution by the shareholders.
I have mentioned
Please.
this, you don't need a special resolution for that. In the resolution itself, when you're getting that scheme as well as this thing approved, the number of shares and all, if anybody you're proposing to allot more than 1% of that shares of the offer, then you have to mention their names and designations. So it should be a part of that approval itself.
It is a new learning that a consultant exclusively working for the company can be allotted ESOP. Can I get the more clarity on this, please? I think Sudhakar is asking you, I think.
See, I have mentioned that, these consultants are mostly internal consultants, and they are not working on a assignment to assignment basis. They are working more or less like an employee. So only thing is, it is a designation wise they are consultants. So when you are proposing the scheme, that point of time itself, you have to give that as per the rules. You can give it to the consultants also, but that consultant also should be in the more or less like an employee, internal consultant. It should not be an external consultant.
What are the
Address
RBI
that
reporting?
issue scheme properly. Yeah.
What are the RBI reporting requirements if there is a ESOP shares which are issued to the foreign holding company and its subsidiary company employees?
This I have mentioned earlier, expat employees, if there are any, that you can award the grants to them subject to the FEMA regulations. Whatever the compliances are there, you have to do that.
Next question is regarding to the valuation report, which we talked about it. Then it is
Sir,
appreciation.
can
Yeah.
we take one or two last question and then wrap it up? I have another meeting.
Sure, we can do that. There's no issue at all. Then again, next question is the value. Let me go through this actually. The next question is the valuation report which you addressed. SH8, he has actually answered this actually. If there's an error, okay, it is all right. Can anyone transfer the employee? That also he actually asked. In the EC stage of the startup, it is a letter issue of the SI employee. What are the long-term tax and governance, that also we discussed actually. Kindly clarify whether direct grant of the ESOP trust route, that also we talked about enough. How do you ensure the ESOP do not conflict with the SHA received matters? No, ESOP is a separate scheme. That is what he said actually. There's no question of conflict or something like that in this. How can the ESOP handle it during the conversion from the private company to the public company?
There the SEBI regulations will come in picture, and I think, I mean, someone has to study this in detail. This cannot be answered in one or two lines.
Basically, you
Where,
have to align your scheme as per the SEBI regulation.
Yes.
where the unlisted company options application window monetarily, quarterly, or ESOP exercise. I think those Sudhakar talks about it will differ upon because they used to have every month 22nd allotment. Other people used to have quarterly. That's what he said actually. When unlisted company has a quarterly, monthly, this also we talked about it. In case of the amalgamation between the two companies having a different ESOP policy, especially with a different vesting and change in control issues, how the outstanding options are treated.
You have to address that amalgamation scheme itself. You have to address that issue very clearly, how we are going to deal with that.
Valuation, we talked about it. Okay. ESOP can be issued contract, that also we talked about it. If the company is proposed to ESOP and the company is like a private limited company, how come the limited can be further execute? If the company is a proposed option to the ESOP and the company, private limited company now becoming a listed company, that he talked about it. Is valuation necessary? That also we talked. What happened to the unvested ESOP during the liquidation?
I think nothing will happen to till the time it is ESOP, and if it is unvested, if the company is in liquidation, that itself is a big question whether the ESOP will be exercised or not.
If the company proposed to option the ESOP when the company, private limited company, now the company, this we talked about it, private and public. Valuation, we again talked about it. Under Rule 12 of the company's share capital and debenture Rule 2000 company, a startup recognition, the startup recognized by the Department for Promotion Industry, etc., trade to the following individual who are normally ineligible in the other companies, in other companies. Under the Rule 12 of the company share capital debenture rules, a startup recognition by the Department Promoter Industry and Internal Trade can grant ESOP to the following individual who are normally ineligible in other companies. I'm not very clear about this question.
I think the simple way to look at it is that ESOP can be granted to employees and directors. ESOP cannot be granted to independent directors. I think that is the simple way this should be looked at. There is no need to complicate it.
Is FEMA approval required for issuing the ESOP to the expatriate and again for the remittance of the share proceeds?
This, I think, Sudhakar sir just mentioned that the FEMA regulation has to be adhered to.
The gap of 10% will not be applicable to the recognized startup company. Is the gap of 10% will not be applicable to the recognized startup company? That is the question.
What is the cap of 10%?
I don't know. It's written here.
Skip it, go to
It's
the next question.
okay. If the article do not explicitly authorize ESOP issuance, but the shareholders' approval in the scheme, would it actually be allowed to alter the article of the association's
So articles
required
have to
before?
approve. Articles have to, first of all, they have to be a provision in the articles, otherwise amend the articles and then only you can proceed further.
What are the mandatory things that needs to be mentioned in the ESOP scheme?
That is a big, so far we have discussed all those issues.
SAR is governed under which law?
Unlisted companies, Companies Act, otherwise SBAB rules.
Can the board accelerate vesting period shareholders approval? The ESOP scheme gives general discretion. This you addressed actually. Regulation 23 regulates a Companies Act shall be dealt by the ESOP. Yeah, I think I have done with the questions now. There is no more questions are there actually. We are done with all those things. Let me see if any hand is risen. No, no hand is risen. Sudhakar, your hand is risen.
No, I have not raised my hand.
I don't know. It is appearing. Sorry, it is somebody. Sushant Chandar. Sorry, I wrongly read it. Sushant Chandar. Are you there, Sushant Chandar? If you are there, you can unmute and you can speak. I can see your hand risen. Sushant, are you there? I don't think so. I think Sudhagar, I think we can actually close because
Yeah,
since we
please,
already
please
answered all
close
the
it.
questions, is already 1:10. I think one of the panelists also is to leave. I think we can definitely close.
Yeah.
Now, even at the closing time, we have about 160. The participants are well over 290 and plus. I must say it is really, really a wonderful session. There are a lot of learning from both the panelists. It really added personally value to me. I definitely hope it would have definitely added value to the other participants also looking at the various questions and discussion, etc. It's a wonderful deliberation. I take the opportunity for thanking both of you, Rohit and Anand, and very great sharing of the experiences. Thank you very much.
Thank
With
you, sir.
this, we close our session. Thanks a lot to everybody. Thank you.
Thank
Sir,
you.
Close.
thank you from my side also. It was very interactive and knowledgeable, session. The questions from participate were good quality question, and I appreciate Sudhakar sir also has very deep knowledge about his experience from Reliance Industries, which he shared. So it was a learning for me also. Thank you so much for having us
Thank
on
you.
the
Thank
panel.
you very much. Thank you.
Thank you. Thank
Thanks,
you.
thanks, thanks, Amal. Have a good weekend. We'll meet in the next week somewhere. Thank
Thanks,
you.
everyone. Bye.
Thank you.
God
Thanks.
bless.
Bye-bye.